Have you ever wondered why, despite having all the right information, your investment decisions sometimes feel like a roller coaster ride? I'm Patrick Lonergan, and welcome back to the Vital Wealth Strategies podcast. Today, I'm thrilled to introduce our special guest, Jonathan Blau, the owner and CEO of Fusion Family Wealth. Jonathan is a leading expert in behavioral finance, specializing in helping advisors guide their clients to understand how our behavior influences our investment choices. In this episode, Jonathan shares invaluable insights on why embracing market ups and downs can lead to better returns and how to foster a mindset that prioritizes long-term goals over short-term performance. Whether you're an investor looking to make more rational decisions or financial advisor seeking to better educate your clients, you won't want to miss the strategies and wisdom Jonathan brings to the table. Stay tuned as we unpack the secrets to becoming not just resilient, but anti-fragile in your financial journey. Let's get started. Jonathan, I appreciate you joining us here today. On the show, we've got Jonathan Blau, the owner and CEO of Fusion Family Wealth. He is the advisor to advisors when it comes to helping clients understand the impact of how our behavior affects our outcomes when it comes to investing. So thank you for joining us here today.
That was my pleasure. Thank you for inviting me to talk with you and address your audience.
Yeah, thank you. So, Jonathan, if it's okay, can we just start off and sort of lay the foundation for what behavioral finance is and what that really means to our clients? Because on one hand, I think we pretend that we're awfully logical in how we make our decision making, but at the end of the day, that's not always the case.
Sure. No, of course. Well, I guess a good place to start is the leading assumption in economics throughout most of our history has been that we are what are called homo economicus. We're perfectly rational when we make decisions, economic decisions. And what behavioral finance and the study of behavioral finance found out is not only is that not true, but we're innately programmed to make systematic errors, predictable errors, repeated errors, time and time again. So not only aren't we perfectly rational, we're imperfectly and consistently irrational. And so behavioral finance takes a whole other look at how we actually make decisions as opposed to how it's always been assumed that we make decisions. And so, for example, one of the things that's been proven in terms of how we make decisions about not just money, but anything in life that might be something we're planning to have a benefit from in the future, is that we put a lot more weight on the potential for loss when we make a decision than on the same potential for gain. So it's called loss aversion bias. The pain of a loss to us is felt 2 times more than the pleasure of a gain is felt pleasurable. So if we're looking to make a decision and say, hey, I'm 55, I'm going to retire in 5 years, and I'm going to hopefully live 30 years after that, I've got to invest in things that are going to attack and help me control my biggest threat, which is the erosion of my purchasing power over a 30-year period of a trend line 3% or more in healthcare, et cetera, inflation, which is arguably the disease of money.
Right.
And the things that cure that disease are things that cause your dollars to grow over time, and those are investments in companies as a stockholder. Bond investments cause your dollar to freeze in the face of the 3% compound inflation, and so because of loss aversion bias, we don't seek out strategies like stock investing that can maximize our long-term wealth. Instead, we seek out strategies that minimize the chance that we have at experiencing a short-term loss. And those strategies, cash, bonds, et cetera, are the opposite of the strategies we actually need to help secure the value of our dollars over the next 30 years. So that's just one example of how we don't think about it rationally at all.
I love that. And I think it was Richard Thaler. I read a book. It might have been Nudge. I can't remember exactly which one, but and it could have been somebody else altogether. But it talked about investors that get monthly statements versus annual statements. And the annual statements people outperform the monthly statement people. And it was like, wait a minute, this doesn't make any sense. But what happens is, and you can opine on this, but the people that get monthly statements, they go, oh, the market did something. I better go fix it, right? I better, I'm scared of loss, so I better adjust this thing versus the annual statement, people look at it and go, "Oh, I've got more money than I had last year. Great." And they don't change anything. So, yeah, it just seems like it's an interesting
Yeah,
phenomenon. I
no,
don't think
the study showed, and there might have been more than one study because the study I'm thinking about showed that generally, the more often investors look at their portfolio, the worse they do. And the
yeah.
reason to your point is because whether it's responding in a good or bad way, they're responding frequently to the news they're getting or the performance they're seeing up or down by reflecting the thought about that in the short run by changing the portfolio in response to what they see and ignoring completely what's good for the long run and usually interrupting their compounding, which Warren Buffett's partner, Charlie Munger, said is the first sin, basically investing, and never interrupt your compounding unnecessarily. But that's why. So that is true. It's a real empirical studying, and that's the reason why. The other thing is, as I mentioned, is when people look at their portfolio frequently, we are much more sensitive to the change in the value of our wealth than
Uh-huh.
to the overall value of our wealth. So I have $10 million, feels good, but I've been used to that. Doesn't impact when I look at it every day. But when it's down 300,000, that change, that's what moves me. And the same, you said,
Yeah.
what moves me is not that I have 10 million, but if I make another 300, that moves me. So we're much more sensitive to short-term moves in terms of the
Mhm.
change and to losses in particular. So that's a very powerful loss aversion bias, as well as our
Yeah.
sensitivity to change as opposed to overall value, is very powerful in terms of what motivates us to make decisions.
I love it. So, I think one thing we're talking about here is volatility and how that can sort of get the average investor in an unhealthy mindset. And I think you argue that I think rightfully so that volatility is our friend, right? Like when we're seeing those ups and downs, when we're seeing if we've got a $10 million portfolio, $300,000 in change, it's like that's feels scary to me. I should probably go fix it. But can you talk about how that volatility can be our friend?
Sure. So, my simplest way of thinking about it is we have about 100-year history almost for the S&P 500, and for
Hmm.
most of that period, the average return has been something north of 10% a year compounded. But then we have inflation, which has been about 3% a year for that period.
Hmm.
So if you take the 10% a year that S&P 500 owners of the greatest companies, arguably in America and the world, best managed, best financed, what they've made after inflation is the 10 roughly minus the 3 or 7.
Yeah.
An equivalent, not the exact same, but portfolio over that same period of time of companies that are just like the same companies in the S&P, done always exactly the same, but same industries and so forth. Of bonds where you loan money to the companies, that
Hmm.
portfolio over the period of time that we're talking about has made 6% a year. After inflation, that's roughly 3. So stocks after inflation 7, bonds after inflation 3. So why would one rationally look to give up 2.5 times more return that's been available for the last almost 100 years on average in stocks to buy bonds? And the reason is because they're afraid of the ambiguity involved with the returns from stocks, meaning we don't know the timing and the magnitude of the ups and the downs that we're going to experience, even though it's made 10% a year. Whereas in the bonds, we kind of know, even if we're willing to take less than half, that we're going to be sure about what we're going to get. And oftentimes, investors are much more comfortable taking something that's sure, even if the probability of the outcome is going to be a much worse one. It's high probability to be a much worse one. They'd rather take the sure worst potential outcome than the one that's most likely to be a high probability of being better outcome, but with much more ambiguity. We have an ambiguity bias. Now, why I say volatility is our friend, what's crazy to me is the reason that we get 2.5 times more return as owning great companies versus loaning to them is simply because for those of us who are willing to put up with the temporary, often sharp, always unpredictable in timing and magnitude, uh, temporary declines. So just
Hmm.
to be able to put up with that, just to be able to behave, I'm going to get 2.5 times likely all of history, more money over one period of time. I want to do that,
Hmm.
right?
Yeah.
But left to our own devices, human nature can't do it because the impulse to run away from the potential of danger, not just actual danger,
Right.
is
Yeah.
is is it's autonomic. We can't control it. It's a physical response from the organs in the base of our brain. These nut-shaped organs
Yeah.
that are called the amygdala. And so volatility is our friend because it gives us that great opportunity simply to just stand by and say, I'm going to be okay, and I'm leaving my investments to compound. And for that approach, I'm going to get a huge reward. At least historically, I've always been given a huge reward for that, for doing that.
Yeah. Yeah, I love it. And you had a quote earlier that you said something to the effect of, our brains can't tell the difference between a bear chasing us and a bear market, right? Like they
A
both.
bear in the woods and a bear market. Right.
Right,
Exactly.
right. And so it feels, both of those things feel dangerous to us. And so I think one of the questions I have is like, how do you help people overcome those emotions, right? Like, because both of those are relatively scary. What does the client education look like to say, hey, okay, um, this looks like a scary thing, but at the end of the day, it's not. And here's why it's in your best interest to stay the course.
Yeah. So I think it's a good question, and it's got a combination of variables that go to address it. So I'll try and just tell you
Hmm.
how we do it.
Yep.
How we address it. So the first thing we do at its very basic level is to not approach the client, the investor, who really, when they come to someone like me or like you, they're looking for, I always say, one thing. They're looking for certainty about their financial future, as much as they can get. And the trouble, I tell them right away, is most of our industry, the big firms, the Merrill Lynch's, the Goldman Sachs, not all of the people there, but as a culture, the way they address that need for uncertainty is generally by handing you back the illusion of certainty. So they tell you how many analysts they have in each industry, and they're going to tell you which industries are going to do better than the others and when, and how many economists they have, so they can tell you when we'll go into recession and recovery and get you in and out of the markets based on that. And so I tell them nobody can do those things consistently. So we're not embarrassed to tell you we don't do any of those things because nobody can do this. But more importantly, rather than hand you back the illusion of certainty with parading these things around, outperforming the market, all that, what we do is we teach you how to make rational decisions when we are always under a constant state of uncertainty. Not
Uh-huh.
just as it relates to investing, by the way, I tell them, but certainty doesn't exist anywhere as a condition in nature, right? So take it there.
Right.
But in terms of now, how do you survive as an investor, right? So the first thing we tell them is understand that for every year roughly since 1980, according to J.P. Morgan's quarterly guide to the markets that they put out every 3 months, the S&P has declined almost 15% every year for any or no reason, and 1 year in 5 or 6 declines more than twice that, average about 33%. So if you can't watch your stock portfolio appear to disappear each and every year to the tune of 15%, and watch it appear to disappear 2 times or more that amount, 1 year in 5, don't invest in equity. You'll never make it. So that's the
Yeah.
first thing we do, right? The second thing we do is you try to, there's the idea of resiliency, right? You want to so investing to us successfully doesn't require finding what the best investment's going to be for the next 3 years, 3 months, whatever. It requires finding what is the likely investment you can find with the return that you could sustain, average return, for the longest period. That's compounding.
Right.
Compounding is return to the power of time, where time is what's doing the heavy lifting, not finding the hot thing in and out. And
Yep.
and so when we go over that, the key then to success is endurance and longevity. Don't go on leverage because you'll never have the endurance,
Mhm.
and then you'll never have the longevity to benefit from the compounding. So the concept of resilience is to say, gee, if I can try to help my clients get through whatever crisis is next, right? Whatever or current, and they get through it, but they get through it the same way they went into it, meaning they don't feel any better the next time there's a crisis. They'll kind of get through it. They'll cringe. That's resiliency. But what
Uh-huh.
we want is what Nassim Taleb wrote about, which is anti-fragility.
Yeah,
We
I love
want to
it.
say you come out anti-fragile means you don't just come out squirm and you're going to do the same. Now you're coming out and say, I've been through this before. I want to leverage my house now with this opportunity and buy more. I'm anti-fragile. I don't care. So
Yeah.
and the key to all of this is educating clients. I think that We don't own the stock market. As my mentor,
Mhm.
Nick Murray, always says, we have a vision when we talk about stock market of this writhing, slithering bag of snakes somehow, right? Um, and what
Yeah.
we own is we own great companies, right?
Mhm.
Arguably the best companies through the S&P as an example in
Right.
America and the world. And when we get into a crisis where the market's down on average in a bear market 33%, there's always a real crisis. But what
Mhm.
is it that clients always say? What's the four-word statement they make when they want to bail out during a crisis? What do they tell us?
Um, I don't know.
I call it the four-word death song of the American investor.
Okay.
This time
Is different.
is different, right?
Yeah.
So they're not
Yeah.
concerned and afraid of the nature of the crisis or the number of the
Yep.
crises. They're just concerned about the difference.
Yep.
And the fact that it's different is irrelevant. 1987, one day drop of almost a quarter of 25%
Mhm.
was different than the dot-com implosion, was different from 9/11, and was
Mhm.
different from COVID. And the
Yep.
thing they all have in common is that by the time the market's down, I don't know, that's my opinion, 30% or
Mhm.
so,
Yep.
every point of decline beyond that is no longer discounting the crisis that they're worried about. It's discounting all of the insanity of all of the participants in the stock market. And at
Right.
that point, it's going to rubber band back like it did after March
Mhm.
to February to March of 2020 COVID, right? Went back up something like 80% in the 6 months after that decline. It always has worked that way. And so if you can train them to not think of themselves as investors in the stock market, which they're not, because when we get to those extreme declines, the value, long-term enduring values of great companies goes off in a totally different and opposite direction than the current price the market's putting on it. And investors can't hold those two things together. They're either going to focus on the long-term enduring value or the current price. And we've got to train them to focus on those values and let them know that's what you own is these great companies who go into crises not as victims, but as
Mhm.
as opportunists. Right.
Yep.
So when Marriott kind of shuttered their whole operation in the face of COVID, they couldn't have any employees. They went and bought other less successful firms who couldn't deal with the crisis at deep discounts, came out much stronger, right? So anyway, that's it in a nutshell what we try to do.
Yeah. I love it. I love it. And I think there's also it's hard to quantify the value of an advisor in that situation, right? Because the individual investor left to their own devices is going to go trade that portfolio however their emotions are driving them to, right? Where when they call their advisor and go, "Hey, this time is different. We need to change it. Let's go fix it." We can go, "Hey, all right, let's educate you on the things that have happened in the past, and here's why we're going to stay the course." And we're a believer in having an investment policy statement that just says, "Hey, I really like Morgan Housel. He's written a couple books.
He's
The
great.
first, yep, Psychology of Money and
And
Same
his
as Ever."
podcast is great.
Yeah, I really like Morgan Housel, and we'll have links to all of his stuff in the show notes. But Morgan does a great job. And one saying that I love from him is volatility is the price of return. Like
Yes.
if we want to get
Volatility is a fee, not a fine.
right, yes,
It's
and so
you get a
yeah,
benefit for it. You're not paying a penalty for it.
absolutely. So it's like, if we want to get, those, better than bond returns, we're going to have some volatility with that along the way, and we can help coach our clients
That's
through
right. We
that.
can't steal those good returns, right? We have to
Yeah.
pay something. And it's not the currency is volatility, right? That's the best
Yep.
way. But people want to get it for free. That's timing the market. I don't want the only way to garner anywhere close to the fullness of those 10% returns over the last 100 years was to be willing completely to be able to take in every bit of volatility that came
Mhm.
along with it. And so it's important that investors understand that, right? There is
Yep.
no shortcut to that successful path.
Yeah. I love it. This is great. So I'm just wondering, when we're looking at, uh, it seems like oftentimes though firms will sort of.
By the way, I want to step
Yeah.
back because I'd be
Yeah. Yeah.
remiss.
Please.
I remembered I wanted to make a point and I forgot what it's about. But when you said sometimes hard for us to quantify our value, from
Hmm.
my perspective, a behavioral investment counselor, which is what I consider what people who do I do practice, it's couldn't be easier, right? So if I say to someone who's questioning your fee, by the way, they're not. They're really questioning your value, right? So you've
Yeah.
got to be able to demonstrate it. So I say to somebody, if I if during COVID during the '08 or '09, financial crisis, you
Hmm.
had $5 million invested in equities. I'm making it up. And without me, you would have sold some or all of it. Let's just say $1 million worth of it at the bottom in COVID, right? So COVID's bottom was 2,000 on the S&P or 2,200. Now we're at 6,000. So it's 3 times. So if I got you not to sell 1 million, which you probably still
Hmm.
would be out of because you never had a chance to get back in, it happened so quickly. So if
Right.
I did that for you, that million today, right, has gone up 3 times. It's 3 million. I don't
Uh-huh.
think I could charge you a fee high enough to reflect the value of what I did for you in that one
Right.
instance of saving you from a big mistake, of which we're prone to make many of over a multi-decade lifetime of feds and fears that we're going to face. I couldn't charge you enough for my grandchildren to justify the value that we provided there, right?
Yeah.
That's right. So if you're paying someone roughly 1% to manage $55 million, it's fifty thousand
Hmm.
dollars in fees. That
Yep.
one thing, 50,000 in fees over 30 years, $1.5 million. That one thing saved them 3 million. And how many of those things do investors face? Not even over decades, but even sometimes intra-year. So
Yep.
that's the value. So I look at it as Nick Murray says. Think of it as big mistake insurance. Is that
Hmm.
you're paying me
Yeah.
roughly a penny on the dollar to help you from avoiding to help you
Yeah.
avoid those big mistakes. You don't have to die to collect my fee.
Yeah, I love it. I love it. And I think one thing you also highlighted that Taleb also points out in his books is the we'll call it the expert fallacy. The expert is actually really bad at making predictions as to what's going to happen in the future. And so it's like, we go to these huge investment firms and they've got all of the analysts that are going to tell you what's going to happen in the market, and
I told you, right? The
they're
illusion
wrong.
of certainty. They're giving you
Right.
the
Yep.
illusion of certainty.
Absolutely. So it's like you should almost like when somebody says, "Hey, I'm an expert in this," your like radar should be up. Like I shouldn't trust anything this person says.
Yeah.
They're
Well, you
they're
know
more
what's
likely to be
interesting?
wrong.
I forget who, like you said earlier, forget who did the study with the
Mhm.
looking at off in the, but it's
Yeah.
a real study where there was a study that showed expert forecasts are right at 49% of the time. So it's the
Hmm.
equivalent of a coin toss.
Right.
But what they also said, which is interesting, is that the experts who come across the best and are the most believable when you look at them on TV, they're the ones who are the least accurate. So those are the ones you're most likely to follow. So yes, I agree with you. Expert
Yep.
forecast is out the window. Look, Mike Wilson from Morgan Stanley going into 23 said, "Oh, we're going to go down and test new lows." It's doubled from where he said we'd be at new lows. The same guy, I forget his name, was the head of J.P. Morgan's investment committee, and David Costin from Goldman, who seems to flip flop all the time. But they were
Yeah.
all, you got to protect yourself, and couldn't have all been wronger than they were
Right.
recently.
Absolutely. And yeah, and I think a little bit of the challenge there, these guys are probably going, "Hey, we know what the history of markets looks like. We're maybe if you don't count the COVID sort of dip and quick recovery, we might be overdue for a recession. So, I'm just going to guess that this year is the year for the recession." But the problem with that is it sort of leads your clients down a bad path. They get out of the market or they get more conservative. They're missing all this upside. They're frustrated by that. Then they get back in, and then the market drops off. It's like, no,
Well,
you just
think
have to
about it.
maintain the
Think
course.
about what you just said, because you're right. What you just said is here you have clients who are looking, from my perspective, for one thing,
Uh-huh.
certainty. Here you have an industry that satisfies that need by giving them the illusion of certainty. And the more often they give them the illusion by coming up with forecasts, which is a version of the illusion of certainty, they're doing the opposite of what we're trying to do. We're trying to
Mhm.
say, always act on your plan. All
Yep.
successful investors are goal focused and planning driven. All failed
Mhm.
investors are market focused and performance driven. We want you to get away from that. But what the industry is doing is they're the carrier of that disease by constantly coming out and igniting these biases that don't need much fuel thrown on them. They're throwing the fuel all day and all week long on CNBC or anywhere you look, 24/7. And so that's one of the things that, from the way I practice, is a friend to me, because that's given me the ability to add the value I add. Otherwise, if they got on TV and said what Nick Murray says, it says, he said, look, what you have to do is you have to come up with a date-specific and dollar-specific plan. You have to always act on the plan and never react to short-term market moves, current events, or economic and geopolitical news. If they said that every day, they'd go out of business. No one would advertise. No one would click on story. So,
Yes. Thank you. Because one thing that people don't realize, and this is every media, not just the,
not just
CNBCs
financial.
of the world.
No, that's right.
Right. But their job is to create some outrage. So you'll tune in tomorrow so they can sell more advertising. If they don't create the outrage, you're not going to tune in. You're going to be like, okay, I heard the same message over and over again. I've got it. So I think people need to be, aware of that, because,
they don't know the
out there to
purpose,
manipulate you.
They don't realize that the purpose of the media, in this case, financial CNBC, is not to be able to give you good investment advice at all. They're not qualified, most of these people. What it is to be able to get you to click on their stories more and more so they can increase their ad rates and increase their revenues. Now, when you understand that, the old line in the media that I always quote is, if it bleeds, it leads.
Yeah,
and
absolutely.
That's what attracts people, right?
Yep.
When they tell us that a plane unfortunately just crashed, we think, oh my God, I'm not going to fly tomorrow because the plane just crashed. But had they told you the hundreds of planes or more all week that went up and down without event, you would be having a much better contextual framework to think about it rationally.
Right. Yeah. I love it. All right, Jonathan, now I'd like to shift focus just a little bit, because I'm thinking about the mindset for most of our entrepreneurs. They have the exact opposite of what you're talking about. And I'll explain this here in just a second, but they have a concentrated position owning, their business. They have millions of dollars of net worth tied up in this. Oftentimes they're using leverage to sort of get that business to grow rapidly. And so this thinking got them to a certain point that most people can't get to. Okay. There's also a bunch of people that don't become clients that never made it and they went broke, right? Trying to start a business. Statistically speaking, you shouldn't do it. Go get a W-2 job and you'll be better off.
Statistically speaking, the latter group you talked about is more populous than the former group.
That's right. Absolutely. So the thing that I think we have a little bit of a challenge with is, our clients are sharp people. They've made tremendous wealth taking risk. And now I'm trying to shift their mindset to go, hey, okay, we've done that. Now let's preserve our wealth over here in this bucket. We don't need to own, 100% of NVIDIA stock or Amazon or Tesla or Bitcoin. We need some diversity, and we need to not have the leverage. So can you just talk us through maybe both of those different mindsets and how, really the one, if we want to have certainty in our financial outcomes, we need to take a more diversified approach.
Right. Well, I think the first thing to do with people, and that is the mindset of an entrepreneur and oftentimes successful executive too, similar, is they do suffer from, and I'm in that camp because I'm an entrepreneur, we suffer from something called overconfidence bias, right? So it just means that because we've been so successful in an endeavor that we took, or some endeavors that we took, that we leveraged and put all our resources into this one or two things, and we succeeded against all odds. There's a couple of things there. One is there's this the thought that the causal relationship between skill and the success is all there is. They don't attribute anything to outside influences that change the outcome to be even more positive. We call that luck, right? When they fail, they look, as Morgan Housel says, they'll look at risk and say, well, the reason I failed is because of these outside influences that change the outcome. We call that risk. It's the same thing, luck and risk, on two different sides. But so we get overconfident because of that. And when we get overconfident, what happens is, as successful as we are, there is this kind of reflexive association between wealth and wisdom. If someone's wealthy and successful, we think they're wise in all areas, and I found that to be not at all true when it comes to investing. When someone has success somewhere else, but they do get overconfident. And the problem is, we're all the same, whether I'm a successful entrepreneur, have a PhD, never finished high school, any of it. We're all
Mhm.
prone to the same human nature issues that are innate in terms of the decision-making problems we all have when we're faced with uncertainty. They don't admit that to themselves because of their success. So now the overconfidence bias is like a big magnifying glass over all of these biases that they have like the rest of us. So it just magnifies the mistakes they're going to make by sometimes a factor of 10, you know.
Yeah.
And so that's one of the problems. The other problem is something called familiarity bias. It
Mhm.
deals with how when we're making a decision about, over concentrating in something or not in this case, we don't look at the rationality saying, I've made it, right? I've made it. I've got everything I need. Does it make
Mhm.
rational sense to take what I need now and risk it on something I don't need, which is to now multiply it hopefully by 10 more times, but risk what I already have and need? No, of course it doesn't, right? But the problem is when we have an investment in something that we're familiar with, my company, something I created, we
Mhm.
think that it'll help us more and hurt us less always than something I'm not familiar with. So we no longer look at that as concentration risk, even though it is. We have all our money in the one thing, whether we know it or not. We don't know what the future holds for it.
Yeah. Yeah, no, I love that. This is great. So, I'm just thinking through, we've covered a lot of ground on, decision making and how we should approach these things. You've worked both, excuse me. You've worked extensively in both tax planning and the wealth management piece. And are there any lessons out there that you wish people understood that we haven't talked about yet?
Yeah, I wish we didn't really talk about it directly, but I wish people would start to be a little bit more introspective about what's important to them
Mhm.
as they endeavor to protect, build, and grow their wealth. In other words, what's important to us from an emotional behavioral standpoint is not maximizing our opportunity and being happy with what we achieve. It's always a relative concept. Am I doing better than this person or that person? And
Yeah.
so I wish people would take this one simple equation when they're making the kinds of decisions we're talking about improving their life or what they're able of wanting to achieve is the one measure of wealth that's not uncommon is what you have minus what you want. And if that
Mhm.
is not a positive number,
Yeah.
if based on that measure, there's many poor billionaires out there,
Yes.
right?
There are,
And,
absolutely.
and
Yep.
so I think that's the biggest thing I could tell you is just stop moving the goalpost and
Yep.
start taking a step back and saying, there's always, Warren Buffett's partner again said, there's always going to be somebody richer than you, and that's not a tragedy. Right?
Right. Yeah, absolutely. Yeah, no, that's an interesting point. And one thing that I did, on that point was I took a year and I said, I'm not going to buy any more material stuff. I'm just going to see if I can find some satisfaction in, all of the things that I currently own. I'm fine buying necessities, but the thing that kicked me over is this this shirt I'm wearing now is sort of the shirt that I wear every day. I have 21 of them in different colors, but you know, it was like I probably don't need any more of these. I probably don't need any more pants. I don't need any more shoes. Like, let's just take a pause for a minute and see if we can find some satisfaction in the things that we currently own. And it was just interesting to go, wow, all right. Um, I don't need, because you talk about the billionaires and how they're dissatisfied, and they have a 300-foot yacht, and then they go buy the 320-foot yacht because their friend got a 310-foot yacht, and it's like
Right.
I don't think that's going to contribute to your happiness,
Well,
and
it doesn't. You know why, by the way, and maybe we could end on this, and wrap it up. But the reason is a couple of reasons. One is that we're not, the person with the 300-foot yacht doesn't really care about the 350-foot yacht. They care about the dopamine rush from the anticipation of getting the 350-foot yacht and then the 400-foot yacht. So that's why you're never happy, because the brain isn't craving the new yacht or the bigger house, but it's craving the dopamine rush. So it's like a
right.
drug. You're always going to want more. So you can't. So
Mhm.
those things can't buy the happiness for that reason. But the other thing is this guy, and this is from Morgan Housel. He talked about this Renaissance man, Montesquieu. I don't know if it was
Mhm.
from the 1700s, 1800s, but the quote was something like, "If all we wanted was to be happy, it would be easy to accomplish. but what we really want is to be happier than other people, which is almost always difficult because we deem the other people to be happier than they are.
Yeah. 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 No,
Right?
and that's a great point. I think that's a great place to stop. And I think it also maybe highlights a little bit of our social media world we live in. I don't think it's helped us when we, just have this constant feed of, smiling, happy people doing amazing things on our,
No, I
our
call that
phone.
the Facebook reality, right? Why is everybody
Yeah.
else always so happy and I'm not always so happy?
Yeah, absolutely. All right, Jonathan, this was a wonderful conversation about, how behavioral finance can really impact our lives to the positive. Over my shoulder it says make life great, and our whole point with helping clients build wealth is to live a great life, not to have a bigger bank account. And so the things we talked about today were absolutely essential in being able to do those things. So I appreciate all your wisdom and insight.
No, and I enjoyed talking to you. I'll leave you with the last thing that Morgan Housel says about that because I think it's so wonderful.
Yeah.
He says that wealth is not measured by an absolute number. It's measured by the idea that you can now do what you want, when you want, with whomever you want, for as long as you want. And when you reach that point, whatever that means for you, you're one of the wealthiest people out there.
I love it. I love it.
All right.
Wonderful. Thanks so much,
All right.
Jonathan.
Great to
day.
meet you and great to talk.
Yes.
Okay.
Thank you. Bye-bye. Thanks again, Jonathan, and to all our listeners. Remember, managing wealth isn't just about numbers. It's about making grounded decisions that align with what truly matters. As we head into year-end, I'll be sharing some essential tax planning resources to help you finish the year strong and set the stage for a prosperous year ahead. To access the resources that can help you create a tax strategy, head over to vitalstrategies.com/cornerstones. If you're one of the first 100 people to register, we'll give you free access to the tools that our clients have paid tens of thousands of dollars for. These tools are designed to help you pay less tax, build more wealth, and live a great life. Again, that's vitalstrategies.com/cornerstones. Remember, these dollars are better used in your hands than in the government bureaucracy. Thank you for listening and for being a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities for your employees and driving growth. You're vital to your family, fostering abundance in all aspects of life. And you're vital to me because you strive to build wealth, make an impact through your business, and live a great life. Until next time, I'm Patrick Lonergan, and you've been listening to the Vital Wealth Strategies podcast.